Hi everyone. Welcome to this video where we're discussing the ultimate guide to spotting good versus bad investments. Investing your money is a crucial step toward securing your financial future, but with so many options available, it can be difficult to know where to start. That's why today, we're going to be discussing how to differentiate between a good investment and a bad one. Good investments are those that have the potential to provide you with a high return on your investment, while bad investments carry a high level of risk and have the potential to result in significant financial losses. Here are some key factors to consider when evaluating an investment opportunity. Understand the investment. Make sure you thoroughly research and understand the investment before you put your money into it. This includes researching the company, its products or services, and the industry it operates in. When considering an investment, it's important to understand what you're investing in and the company that you're investing in. This involves conducting thorough research on the company, its products or services, and the industry it operates in. Understanding these factors can help you determine the potential for growth and the level of risk involved in the investment. To research the company, start by reviewing its financial statements, including its balance sheet, income statement, and cash flow statement. This information can provide you with a good understanding of the company's financial health and performance. You can also review analyst reports, news articles, and industry reports to get a better understanding of the company and its market. Additionally, understanding the company's products or services and the industry it operates in is also important. Take a look at the company's market share, competition, and potential for growth in the industry. Consider factors such as industry trends, technological advancements, and any regulatory changes that may impact the industry. Overall, researching the investment thoroughly can help you make an informed decision and reduce the risk of investing in a bad investment. Track record. A good investment should have a proven track record of success. Take a look at the company's financial history and consider the performance of the investment over time. The track record of an investment is a crucial factor to consider when evaluating its potential for success. A good investment should have a proven history of success and stability, which can be evaluated by looking at the company's financial history. This can provide insight into the company's past performance and help you determine its potential for future growth. To evaluate the performance of the investment over time, take a look at the company's financial statements and consider key metrics such as revenue, earnings per share, and return on equity. These metrics can give you a good idea of the company's financial performance and help you determine if it's a good investment. Additionally, you can also look at the company's stock price performance over time to see how it has performed compared to the overall market. It's also important to consider the company's growth potential and any potential risks or challenges it may face in the future. For example, you can look at factors such as the company's competitive position, market trends, and any upcoming product launches or developments. In conclusion, the track record of an investment is a critical factor to consider when evaluating its potential for success. By taking a look at the company's financial history and performance over time, you can make an informed decision and determine if it's a good investment. Return on investment. The return on investment, ROI, is a key factor to consider when evaluating an investment. The higher the ROI, the better the investment. The return on investment, ROI, is a key factor to consider when evaluating the potential success of an investment. ROI is a measure of how much money an investment generates compared to the amount of money invested. The higher the ROI, the better the investment is considered to be, as it indicates a higher level of profitability. When evaluating an investment's ROI, it's important to consider both the short-term and long-term potential for returns. Some investments may have a high ROI in the short term but may not be as profitable in the long run. On the other hand, some investments may have a lower ROI in the short term, but have the potential for significant growth in the long run. It's also important to consider the level of risk involved with the investment. Higher returns often come with a higher level of risk, so it's important to weigh the potential for returns against the potential for loss. Additionally, consider factors such as the company's financial stability, track record, and growth potential to determine if the investment is likely to generate consistent returns over time. In conclusion, the return on investment, ROI, is a crucial factor to consider when evaluating the potential success of an investment. By considering the short-term and long-term potential for returns and the level of risk involved, you can make an informed decision and determine if the investment is likely to be a good one. Market conditions. The current market conditions also play a role in determining the success of an investment. Consider factors such as economic growth, interest rates, and inflation when evaluating an investment. The current market conditions can significantly impact the success of an investment. It's important to consider these conditions when evaluating the potential for an investment to generate returns. Economic growth is one of the key factors to consider when evaluating market conditions. A strong economy generally leads to increased consumer spending, which can benefit companies and lead to growth in the stock market. On the other hand, a weak economy can have a negative impact on the stock market and the performance of individual investments. Interest rates are another important factor to consider. Higher interest rates can make it more expensive for companies to borrow money, which can impact their ability to invest in growth and ultimately, their financial performance. On the other hand, lower interest rates can benefit companies in the stock market as a whole. Inflation is also an important factor to consider when evaluating market conditions. Inflation can erode the purchasing power of money over time, and can also impact the return on investment. It's important to consider inflation when evaluating the potential for an investment to generate returns, as well as the potential impact on the overall market. In conclusion, market conditions play a significant role in determining the success of an investment. By considering factors such as economic growth, interest rates, and inflation, you can get a better understanding of the potential for an investment to generate returns and make an informed decision. Diversification. Diversifying your investments can help reduce the risk of financial loss. Consider investing in a variety of different assets, such as stocks, bonds, and real estate. Diversification is a key factor to consider when evaluating investments and managing risk. By investing in a variety of different assets, you can reduce the risk of financial loss and potentially generate higher returns over time. Stocks, bonds, and real estate are just a few examples of the types of assets that you can invest in to diversify your portfolio. Stocks can offer the potential for high returns, but also come with a higher level of risk. Bonds are generally considered to be less risky than stocks, but offer lower returns. Real estate can offer the potential for steady income through rental income and appreciation over time, but also involves a different set of risks and factors to consider. By investing in a mix of these and other assets, you can reduce your exposure to any one particular asset class and minimize the impact of market fluctuations on your portfolio. Additionally, by spreading your investments across different industries and geographic regions, you can further reduce the risk of financial loss. In conclusion, diversification is a key factor to consider when evaluating investments and managing risk. By investing in a variety of different assets, you can reduce the risk of financial loss and potentially generate higher returns over time. So, these are some of the key factors to consider when evaluating an investment opportunity. Remember to do your research, track the performance of your investments, and diversify your portfolio to reduce risk. With these tips, you'll be well on your way to spotting a good investment from a bad one. Thank you for watching and be sure to like and subscribe for more videos like this.